We will move to a very unique chapter today about the API and venture capital. This session is only available in API Day Hong Kong among all the global API days. Part of our audience is from HASTP, and they should be very interested to explore further. Our next speaker, Jed Ng, is a self-taught angel. He managed to back not one, but two startups from their humble beginnings all the way to unicorn status. Today, he is backed by over 1,000 limited partners who trust his expertise and vision. And wait for it, Jed also built the largest API marketplace in the world with Rapid API. Let's give him a big welcome, Jed. On the stage, please.
Hi, good afternoon, everyone. Thank you for joining. We have a few minutes for this presentation. I know it's the end of a long day, so I appreciate all of you sticking by. I'll quickly introduce myself. As a tech operator, I built and ran the world's largest API marketplace with Rapid API back in 2016. I first met them when there were 5 people in a WeWork, when WeWork was still a hot company, so it feels like a very long time ago. As an investor, I've got an exit. I backed 2 companies at seed stage that have turned unicorn. So I think maybe as an investor, I'm not completely terrible. Today, I'm investing at scale. I run a large-scale angel network and syndicate, so I'm backed by over 1,000 LPs. And my latest venture is angelschool.vc. We are a venture education business. We help angel investors build and grow their own syndicates. So I'll talk quickly about why syndicates fit in the venture capital ecosystem. For those of you who are new to this, basically you can think of a syndicate as an informal network of angel investors. They look at the deals from a lead, myself in this case, or it could be other people. They get access to due diligence, they get access to better deal flow quality. In exchange, they give up carried interest in case of a successful exit, right? They share in the upside. I'll talk quickly about why I'm such a big believer in syndicates and why they sit between being an angel investor and classic VC funds. This data here on this chart shows historical VC capital returns in the US from 2009 to 2018. So the way to read this data is that 50% of capital deployed returns less than 1x. They actually lose money. And 30% returns 1 to 3x. This is where they start to generate returns and so on and so forth. So the returns profile fits this long tail pattern as you would expect. So this helps us set context in terms of returns. Now, one of the better companies that has performed for me is this company, Turing.com. Very proud to back them from the seed stage. They essentially provide elite pre-vetted software developers to tech companies on demand. Just like AWS provides infrastructure, Turing provides software developers. And they use machine learning to scale this on a services model. This company, when they IPO, not if, they'll probably generate 100 or 200 multiplier. Fantastic, I love it. I get to tell the story, and I can't wait for the day. And that's amazing and all, but I'm also pragmatic about it. In the grand scheme of this data, that return is so far off this chart that we can't say if it's skill or luck. My ego wants to say it's skill. Reality says there's probably a bunch of luck involved, so somewhere in the middle. Now, with the syndicate model, I get to scale up on capital. The data tells me that the probability of a 10x return is roughly 8%. It's not huge, but it's not minuscule either. So 8% means I have a 1 in 12 chance of hitting a 10x return as an average performing investor. So if I invest, let's say, a $500,000 check, we 10x that into $5 million of profit, and 20% carry, which is upside sharing, is $1 million payout. We haven't done anything, We haven't changed the company. We haven't changed the outcome. The only thing we've done is scale capital and take a slice of the economics, right? So this is why I think the model is super powerful. So let's talk very quickly about the state of venture today and what startups are facing. This data is from Carta, so it's a bit US-centric, but the broad trend holds. What we're looking at here is quarter on quarter since 2020, what valuation changes are across the different stages, right, across the different rows. Key takeaway here is that funding winter started to bite really hard in Q3, Q4 of 2021. We start seeing reds across the board where some of these startups, especially in the later stages, got hit pretty hard. Now, if we look at another set of data points, which is up rounds, which is like the valuation increases between rounds. So C to Series A to B, B to C, etc. We see these markups on rounds actually decrease. So this first column here shows the peak up round multiple. And then we took another data point at Q4 of 2022. And you see across these rounds, there's a decrease or decline in the up round multiple. So that's one message, valuation multiples decreasing across all stages. And secondly, later stage is getting hit particularly hard. Final data point, looking at capital raised by stage. So the different charts here, or the different lines, represent different stages of fundraisings and how much capital was raised. In response to this funding winter and lower valuations, startups are taking in less cash. Basically, this is founders choosing to be more capital efficient, holding on to their equity and not giving up as much of their capital. So with all this in mind, let's talk about a few investing frameworks. How do I, as an investor, look at these companies and how do we evaluate them? Let's start with a few axioms, right? So classical rules that come up in investing. The first one is team versus idea. Is it about the team or is it about the idea? Right? This one tends to be a no-brainer for me. It's all about the team because execution matters. I don't think there's an idea that's so novel and innovative that nobody else has thought about it. And even if you have, if you never do anything about it, it doesn't matter. The more interesting question for me then is, if it's about the team, is it about team or market? Right? So imagine we're thinking about things this way. The vertical axis is the team quality, if we could measure that. The horizontal axis is the market size. And obviously we're going to play here in the top right quadrant. You know, we only care about above average teams and meaningful markets, right? The rest doesn't really matter. So would you pick a rock star team? Would you go on the top or on the right? Any thoughts? Any takers? Team? Any vote for market? All right. My view is this. These axes are not equal, right? They're actually quite skewed, and they look more like this to me. I think that the order of magnitude difference between a good team and a rock star team is what? 20, 30, 50x, something like that. But the order of magnitude difference between a big market, like $1 billion market, and $1 trillion market is like 1,000x. Right? So for that reason, I think the delta on market size is a lot more compelling than how high performing the team is. Third one, defensibility. This one comes up a lot. Every investor that a startup talks to will ask, well, what's your source of defensibility? The things that come up, oh, we have patents, we have data and tech and flywheel. So this is the perception that people think about. I think the reality, especially early stage venture, looks more like this. And this is not, there's no strict science to this, right? It's just to illustrate the point. I think distribution is vastly underestimated as a source of defensibility, especially at the early stage, compared to all of other factors, right? So the simple example is, do you prefer using Teams or Slack? Yeah, but why is Teams crushing Slack? Because of distribution, because Microsoft has enterprise salespeople in every customer, and they'll just bundle it in the annual license. Yeah? Okay, so let's talk about decision frameworks on investing with startups. Here's how I think about it. It comes to these 7 different things, right? Product and service. We're looking for something that's differentiated by 10x, not 10%, right? Orders of magnitude different. Markets, we're looking for huge markets because they differ by 1,000x versus like a 10x. Economics, revenue quality and profit is going to fuel growth, and these things lower dilution, right? Which is better for us as investors. Defensibility, the question here is what assets make it hard for others to replicate your business? And yes, I'm making the argument that distribution can be one, especially in software, where it's easy to replicate. Traction helps us de-risk the business and validate if the strategy is working. Team, we're looking for serious founders who have skin in the game and they have the skills that we believe to execute. And valuation, we're looking for fair price and long-term growth. So just a few examples, right, to like apply this framework into classic models. Let's talk about SaaS. With SaaS, you're looking at a product or service, right? It's a step change over non-digital processes or on-prem technologies. Markets, big, attractive, it's a very big market, and that's attractive, but it can also be competitive, right? Because software, very easy to replicate. Economics, we're looking at high recurring revenue, so good revenue quality, but price points can be low. It takes a lot of $20 a month subscriptions to build a giant business. Defensibility, again, with software, features are easy to replicate, especially in B2C. The second Tinder came out with left swipe, right swipe, everybody was doing it. And then finally, traction, we look at recurring revenue and net retention revenue as classic examples for measuring success. Another example, let's look at marketplaces. Marketplaces effectively create value through aggregation and product UI. You also have network effects, right? It means that they get more valuable as they scale. For the market, you're basically capturing value over fragmented supplies, right? So the more fragmented the supply base, harder to find, harder to discover. This is where marketplaces are particularly strong. When we look at economics, marketplaces, depending on the services, the economics are very different. It can range from a $10 a month service or $10 per hour to like thousands. And the take rates can be on the low end, 5-10% up to 40%, right? So there's a huge range there. And so these things matter. Defensibility, I think it comes down to supply critical mass and then the network effects, right? Again, going back to that as a source of defensibility. And then in traction, we are looking at transaction volumes and GMV. Okay, so let's talk about APIs. How does this all apply? This is my API landscape. I know API Days has their own, but this is mine. Take it with a grain of salt. I started with the bottom. This is about standards, right? You've got technical standards, you've got industry standards. Then you've got infrastructure. Next one on top is about tooling and management. How do you develop stuff? How do you maintain APIs? How do you have, what front ends do you need, or clients? And then you've got abstractions. Here you've got service abstractions, product platforms, and then workflow automations. And then on top are aggregation. So you've got things like directories and marketplaces. High level, my outlook is this. Standards, the way you're going to build a large venture scale business with standards is ubiquitous developer-led adoption, right? Generally, industry-led, less so. On tooling and management, I think API development is a very interesting key capture point because you get these businesses at the start of the life cycle, and then you can start layering on products and services. On API abstractions, I think this is a really interesting category. There are still opportunities, but you need to find the right market to make it attractive. Products and platforms, if you're just using APIs to expose an existing product ecosystem, generally you don't make money. Workflow automations, this one is interesting because with a lot of software applications, what role do APIs play in like streamlining things? And then finally on top, aggregation. Directories, big category. What's the point of finding something if you can't use it? And then with marketplaces, this is a winner-take-all category. It's about scale and critical mass. This was part of my thesis behind Rapid API. We'll skip this and just kind of like end off with one thing because we're out of time. Let's talk about developer culture as a catalyst, right? My general point with this is that we're not going to move things forward by having developers in a room at a conference and us patting ourselves on the back, right? We need to work with business stakeholders to move the state of the art forward. So a lot of my thesis assumptions as an investor is that developer-led adoption underpins everything, and we need developers to build for other devs. Enterprises generally are pretty poorly equipped to incubate and grow successful API businesses because the economics don't stack up with their classical businesses and their P&L. And generally you have this problem of executive sponsors, the P&L holders not being technical, which is a big issue. They don't understand it. Last part of it, I think, is the idea of developer empowerment. In the research that I was doing ahead of this conference, I was looking like, hey, state of the APIs, like what do we say about developer culture? I couldn't really find anything meaningful, right? There is no metric to measure this around the world. But if I were going to do it, I guess what are the key questions that ask? Like how much are developers empowered to make decisions? Do you have a credit card to make a $10 a month API subscription? Do you need to get approvals from your manager ahead of time for like a small number purchase? And do you have to explain usage-based pricing because your manager wants to know how much they're going to pay every month? Okay, so these are some of the questions that I think about, and so I'll end it here. Thank you for listening. I appreciate your time. I'd love to chat after if you're still around.
Thank you. Thanks for your sharing. So in the following, this is time for another exciting panel discussion. Our panelists will explore the topic of API startup trends and fundraising. Please welcome the members to come to the stage. Jade, please. And Tony Tong, Managing Director at GoB Partners GBA. Also Patrick Fan, lead organizer of apidays.hk and CEO of Binovity. Moderating this panel.
The API Connect Hong Kong 2023 conference is powered by Bnovelty Limited. Check out more API-related education content on bnovelty.com or apidays.hk for more information.